When a central bank cuts interest rates, it is an active, immediate transfer of wealth from people who save to people who borrow. And right now, the Reserve Bank of India has officially cut the repo rate. This quadrant chart shows where the economy currently sits. We are in what economists call the Goldilocks zone. GDP is growing at a massive 8.2% pace, while inflation has fallen to record lows, projected around just 2% for the year. Because prices aren't spiraling out of control, the RBI has the headroom to lower borrowing costs without overheating the economy. This shift forces a new financial reality onto everyone. Whether you hold a mortgage, a savings account, or an investment portfolio, you have to actively manage your exposure. The headlines say loans are getting cheaper, but if you check your mortgage statement today, your monthly EMI probably hasn't moved a single rupee. Meanwhile, people relying on fixed deposits are watching their yields drop almost the moment the announcement is made. This flowchart maps how the money actually moves. The RBI lowers the rate at which it lends funds to commercial banks. The banks then protect their profit margins. They rapidly cut the interest they pay out to savers, while strategically bottlenecking the rate cuts they are supposed to pass on to borrowers. Banks do not automatically optimize this monetary cycle for you. If you want the financial benefit of a rate cut, you have to force their hand. The delay in cheaper loans comes down to internal bank benchmarking systems. This decision tree shows your outcome depends on one line in your contract, MCLR or EBLR. Under MCLR, the bank dictates the timing, creating a transmission lag with slow, partial cuts. EBLR forces automatic adjustments, dropping your rate in sync at the next reset. If you're stuck on MCLR, you can pay a conversion fee, usually around 5 to 10,000 rupees, to switch to EBLR. The trade-off is that when the central bank eventually raises rates again, your loan will also become more expensive instantly. If you do not know which benchmark your loan uses, you are bleeding money every month. The moment your interest rate actually drops, you face a decision: lower your monthly payment or get out of debt faster. This table shows a 50 lakh, 20-year loan dropping to 8%. Dropping your EMI saves 1,500 rupees monthly, but maintaining your old EMI cuts 20 months off your timeline. Option A saves 3 lakh in interest. Option B saves nearly 7 lakh. That mathematical difference is almost 400,000 rupees sitting directly in your bank account instead of the lender's. Taking the immediate monthly relief means surrendering years of compounding wealth. This same policy decision actively punishes conservative savers who rely on fixed deposit yields for income. This graph maps the inverse relationship as borrowing costs drop. Locking into long-term FDs after a rate cut traps your money in a low-yield environment. Simultaneously, cheaper corporate borrowing drives company expansion, pushing market valuations, like the nifty PE ratio, upward. To find higher returns, you have to shift capital out of guaranteed bank deposits and into equities. You trade absolute security for market volatility. Protecting your portfolio's yield in a falling rate environment means taking on an elevated risk profile. This macro policy shift is an urgent call to action. If you hold debt, verify your benchmark. Switch to an EBLR loan if you are stuck on MCLR, and explicitly mandate a tenure reduction instead of an EMI reduction. If you are a saver, stop booking long-term fixed deposits. Shift to an FD laddering strategy using short-term deposits so your money stays liquid for future rate hikes. If you are investing, monitor the PE expansion and allocate capital toward growth-oriented sectors like infrastructure and real estate that benefit directly from cheap credit. Financial outcomes during a rate cut are never automatic. Identify your role, apply the right strategy, and actively protect your wealth.